In January 2025, the United States government announced the establishment of a strategic Bitcoin reserve, marking a significant shift in how digital assets might function within national economic policy. To understand the economic implications of this development, we need to examine what strategic reserves actually mean from an economics perspective, how they function within monetary systems, and what historical precedents tell us about their role in managing sovereign debt. Strategic reserves represent assets held by governments to serve specific economic functions, stabilizing currency values, providing emergency liquidity, or backing monetary systems. The United States maintains strategic petroleum reserves to buffer against energy supply shocks, gold reserves that historically back the dollar, and foreign currency reserves to manage exchange rates. Each serves distinct economic purposes tied to price stability, market confidence, and fiscal management. When a government designates an asset as strategic, it signals several economic intentions. The asset has systemic importance to economic stability, the government intends to accumulate substantial quantities, and the asset may play a role in monetary or fiscal policy. Bitcoin entering this category represents a fundamental shift in how governments view digital assets within their economic frameworks. The question economists must ask is what role a Bitcoin reserve serves in broader fiscal and monetary strategy, particularly given current debt dynamics. To understand the economic mechanisms at play, we need to examine the most relevant historical parallel, the Gold Reserve Act of 1933 and the policies surrounding it. During the Great Depression, the United States faced a severe economic crisis characterized by bank failures, deflation, and massive unemployment. The government's debt-to-GDP ratio had climbed significantly, and traditional monetary policy tools proved insufficient. The economic logic behind the gold policies of 1933 centered on several key mechanisms. First, by requiring citizens to sell gold to the Federal Reserve at $20.67 per ounce, the government consolidated gold holdings into centralized reserves. This was presented as necessary for economic stability, allowing the government to back the currency with hard assets and restore confidence in the banking system. Second, after consolidating gold holdings, the government revalued gold to $35 per ounce through the Gold Reserve Act of 1934. This 69% increase in the official gold price accomplished several economic objectives simultaneously. It increased the nominal value of government gold reserves from approximately $4 billion to $6.8 billion, improving the government's balance sheet without raising taxes or cutting spending. More importantly, it devalued the dollar relative to gold, which effectively reduced the real value of dollar-denominated debt. The economic mechanism is straightforward. If you owe $100 and then devalue the currency by 40%, you still owe $100 nominally, but the real purchasing power of that debt has fallen. Creditors receive repayment in dollars worth less than when they originally lent. This is a form of implicit default that reduces government debt burdens without explicit non-payment. Historical analysis by economists suggests this revaluation and devaluation contributed to erasing approximately 40% of the government's real debt burden during the 1930 seconds. The key economic insight is that governments facing high debt-to-GDP ratios and limited growth prospects have historically turned to currency devaluation through asset revaluation as a debt management strategy. This approach avoids politically difficult choices like raising taxes or cutting spending while achieving similar fiscal outcomes through different mechanisms. Understanding current fiscal dynamics is essential to evaluating potential strategic reserve policies. As of 2025, the United States federal debt stands at approximately $37 trillion. The debt-to-GDP ratio has reached 132%, meaning the total debt exceeds annual economic output by a significant margin. Historical analysis suggests that debt-to-GDP ratios above 90 to 100% typically constrain economic growth, as resources shift from productive investment to debt servicing. The annual interest payments on this debt now exceed $1.2 trillion and continue rising as older, low-interest debt matures and must be refinanced at higher rates. Economic projections suggest that if interest rates remain elevated, annual debt service costs could reach $2 trillion by 2027 or 2028. At that point, interest payments alone would consume approximately 40% of federal tax revenues. From an economics perspective, this creates a fiscal trap. The government faces three theoretical options for managing unsustainable debt: growing the economy faster than debt grows, raising taxes to generate surplus revenues for debt repayment, or cutting spending to create fiscal surpluses. Each option faces significant economic constraints. Economic growth sufficient to outpace debt accumulation requires sustained annual GDP growth of 4 to 5% or higher, a rate the United States has not achieved consistently since the 1992. Structural factors like demographic aging, productivity constraints, and existing debt burdens make such growth rates unlikely. Tax increases large enough to generate meaningful debt reduction would need to be substantial, potentially 5 to 10% of GDP, which economic models suggest would significantly reduce growth and create political constraints. Spending cuts of similar magnitude face the same challenges: economically contractionary effects and political infeasibility. This leaves a fourth option that economic history shows governments frequently employ: currency devaluation to reduce the real value of debt. This approach has the advantage of being technically feasible, politically easier to implement under crisis conditions, and historically precedented. The economic question is not whether governments will use this tool, but when fiscal pressures become severe enough to trigger its deployment. The economics of building a strategic reserve involves several acquisition mechanisms, each with different market implications and fiscal costs. The framework established for a Bitcoin strategic reserve outlines multiple channels through which the government might accumulate digital assets, and understanding these channels illuminates the broader economic strategy. Asset forfeiture from criminal proceedings represents the lowest cost acquisition method. The government currently holds over 210,000 Bitcoin seized from various sources, including the Silk Road marketplace and other enforcement actions. From an economic perspective, these assets were acquired at zero marginal cost to taxpayers, as they represent confiscated property rather than budgetary expenditure. The economic value of these holdings at current market prices approaches $21 billion. A second mechanism involves accepting Bitcoin as payment for fines, penalties, and civil settlements. This approach allows the government to accumulate assets while simultaneously generating revenue through enforcement activities. Economically, this creates a dual benefit. The government receives an appreciating asset rather than depreciating currency, while entities paying fines may prefer using Bitcoin to preserve cash flow for operations. Direct market purchases represent the most straightforward but potentially most expensive acquisition method. If the government were to purchase Bitcoin on open markets, economic theory suggests several likely effects. Large-scale buying would push prices higher as demand increases relative to the fixed supply rate of new Bitcoin creation. This would increase acquisition costs while benefiting existing holders, creating wealth transfers from taxpayers to Bitcoin holders. To minimize these effects, purchases would likely occur gradually through over-the-counter markets rather than public exchanges, spreading demand over time to reduce price impact. The target acquisition volume matters significantly for economic analysis. Proposals such as Senator Cynthia Lummis's Bitcoin Act suggest accumulating 1 million Bitcoin over several years. At current prices around $100,000 per Bitcoin, this represents $100 billion in asset value. The economic question is what fiscal benefit justifies this expenditure, which leads to the mechanics of asset revaluation. The economic theory behind strategic asset revaluation centers on how government balance sheets work and how asset values interact with debt obligations. When a government holds hard assets, those assets appear on the government's balance sheet as resources that theoretically offset liabilities like debt. The ratio between assets and liabilities affects credit ratings, borrowing costs, and currency confidence. If a government acquires 1 million Bitcoin at an average cost of $60,000 per coin, the total expenditure is $60 billion. This creates an asset on the balance sheet worth $60 billion at current valuation. However, governments have the authority to establish official valuation methodologies for assets they hold, particularly strategic reserves. This is where the economic mechanism becomes significant. Historical precedent from gold shows that governments can declare an official price for strategic reserve assets that differs from market prices. In 1933, the government purchased gold at one price and then revalued it higher for balance sheet purposes. Applying similar logic to Bitcoin, if the government revalues their Bitcoin holdings from an acquisition cost of $60,000 per coin to an official valuation of $1 million per coin, the balance sheet transformation is substantial. 1 million Bitcoin at $1 million each equals $1 trillion in asset value. This trillion-dollar asset position changes the government's fiscal picture significantly. Combined with potential revaluation of gold reserves from the current official price of $42 per ounce to market prices around $3,000 per ounce or higher, the government could add several $1 trillion in hard asset backing to the balance sheet. The economic question is whether markets would accept this official valuation. Economic theory suggests that when the largest holder of an asset declares an official price, market prices tend to converge toward that level, especially if the government demonstrates willingness to buy or sell at the official price. If the government announces Bitcoin is valued at $1 million for balance sheet purposes and backs that declaration with policy, markets would likely reprice accordingly over time. This repricing has profound economic implications. If Bitcoin rises from $100,000 to $1 million, this represents a tenfold increase in the dollar price of Bitcoin. But economically, this is better understood as the dollar falling in value relative to Bitcoin, a 90% decline in the dollar's value relative to hard assets. Which brings us to currency devaluation mechanics. Currency devaluation through hard asset revaluation creates an economic chain reaction that transmits through multiple channels in the economy. Understanding these transmission mechanisms is crucial for analyzing how strategic reserve policies might affect different economic actors. The primary transmission mechanism operates through purchasing power. If the dollar loses 90% of its value relative to hard assets like Bitcoin or gold, this devaluation eventually transmits to all dollar-denominated prices. In economic terms, if one Bitcoin rises from $100,000 to $1 million and Bitcoin's real value hasn't changed, then the dollar has lost 90% of its purchasing power in Bitcoin terms. This purchasing power loss transmits to consumer prices through several channels. Import prices rise immediately as foreign suppliers demand more dollars for goods priced in their currencies or in hard assets. Energy costs, which have significant commodity inputs, rise rapidly. Food prices increase as agricultural commodities are traded globally and reprice in response to currency devaluation. Housing costs adjust upward as real estate becomes a store of value during currency crisis. Economic research on historical devaluations suggests that consumer price inflation typically lags currency devaluation by 12 to 24 months, as prices are sticky in the short run but adjust fully in the medium term. If the dollar loses 90% of its value through Bitcoin and gold revaluation, consumer prices would eventually multiply by a factor of 5 to 10, though this would occur gradually rather than instantaneously. The debt implications are central to why governments might pursue this policy. The United States owes $37 trillion in nominal terms. This debt is denominated in dollars and must be repaid in dollars. If the dollar loses 90% of its purchasing power, the government still owes $37 trillion nominally, but the real economic value of that debt has fallen dramatically. In real purchasing power terms adjusted for devaluation, the debt burden shrinks to a fraction of its original real value. This is economically equivalent to defaulting on 90% of the debt, but without formal default. Creditors receive full nominal payment of principal and interest, but those payments are made in a currency worth far less than when the debt was incurred. From an accounting perspective, the debt is fully serviced. From an economic perspective, creditors have suffered massive real losses while the government has reduced its debt burden without raising taxes or cutting spending. Economic models suggest this approach is particularly attractive when governments face debt-to-GDP ratios above 100% with limited growth prospects, exactly the situation the United States faces currently. The political economy of this approach makes it more feasible than alternatives because the costs are diffused across the entire economy through inflation rather than concentrated on specific taxpayer groups through tax increases, spending cuts. Understanding market dynamics when governments become major asset holders requires examining how concentrated ownership affects price discovery and market structure. In economic theory, markets operate most efficiently when ownership is distributed among many participants, none of whom can individually influence prices. Government strategic reserves fundamentally alter this dynamic. When a government holds 1 million Bitcoin out of a total supply of 21 million, they control approximately 5% of the total supply. More importantly, if we consider only circulating supply that trades actively, government holdings could represent 10 to 15% of liquid supply. Economic research on market concentration suggests that holders controlling above 5 to 10% of market supply have significant price-setting power. The economics of price discovery change when a dominant holder can credibly announce an official price. In standard markets, prices emerge from decentralized transactions between willing buyers and sellers. But when the largest holder declares a price and has the resources to defend that price through buying or selling, market participants must treat the official price as a coordination point. Historical examples include central bank gold holdings and foreign exchange interventions. When central banks announce they will buy or sell currencies at specific exchange rates, private markets converge toward those rates because fighting against an actor with unlimited resources is unprofitable. The same logic applies to strategic Bitcoin reserves. If the government announces Bitcoin is valued at $1 million and demonstrates willingness to accumulate more at prices below that level, rational market participants will bid prices up toward the official level to avoid selling too cheaply. Liquidity considerations add another layer of economic analysis. Bitcoin markets, while substantial, have limited depth for very large transactions. Daily trading volume across major exchanges typically ranges from $20 billion to $50 billion. If the government or market participants try to buy or sell positions worth hundreds of billions of dollars rapidly, liquidity constraints would cause significant price impacts. This economic reality means that any large-scale government accumulation or revaluation would occur gradually over months or years to avoid breaking market structure. The implications for private holders are significant from an economics perspective. Small holders face asymmetric information compared to government actors who have superior knowledge of policy intentions. This information asymmetry creates adverse selection problems, where informed holders accumulate or sell before public announcements, while uninformed holders react to announcements after optimal entry or exit points have passed. Currency devaluation through strategic reserve revaluation creates substantial wealth redistribution effects across different economic groups. Economic analysis requires understanding who gains and who loses from this policy mechanism, as these distributional effects often determine the political feasibility and long-term economic impacts of such policies. From an economics perspective, creditors lose when currency devalues. Anyone holding dollar-denominated bonds, including treasury securities, receives repayment in dollars worth significantly less than when they originally lent. This represents a wealth transfer from bondholders to borrowers, primarily the government. Domestic holders of government bonds, including pension funds, insurance companies, and individual retirees, experience real losses even though they receive full nominal payment. Foreign holders of United States debt, including foreign governments and investors, face similar losses. Savers holding cash or bank deposits lose purchasing power directly proportional to currency devaluation. If prices multiply by 5 to 10 due to currency debasement, savings by far less than before. Economic research suggests middle-income households typically hold a higher percentage of wealth in cash and bonds compared to wealthy households, making them disproportionately affected by inflation from devaluation. Conversely, holders of hard assets gain. Anyone holding Bitcoin, gold, real estate, commodities, or other tangible assets sees the nominal dollar value of those assets rise dramatically. If Bitcoin rises from $100,000 to $1 million due to government revaluation triggering market repricing, holders experience tenfold nominal gains. Wealthy households and institutions typically hold higher percentages of their wealth in hard assets, creating regressive distributional effects. Debtors benefit from currency devaluation, with the government being the largest debtor. If you owe $300,000 on a mortgage and the dollar loses 90% of its value, you still owe $300,000 nominally, but the real burden is much lighter if your income rises with inflation. However, this benefit depends critically on whether wages keep pace with price inflation. Economic research on historical devaluations shows that wages typically lag price inflation by several years. Initial phases of currency crisis see prices rise faster than wages, reducing real incomes for workers. Eventually, wages adjust upward, but the lag period creates economic hardship for wage earners without significant hard asset holdings. This pattern suggests lower and middle-income workers face near-term losses even if they benefit from debt reduction in the long term. International distributional effects also matter. Countries that do not pursue similar policies maintain their currency's value relative to hard assets, creating significant wealth transfers from devaluing countries to those maintaining stability. Individuals or entities holding Bitcoin in jurisdictions that do not implement confiscation or mandatory sale policies maintain their holdings and benefit from global repricing without suffering policy-induced losses. The economic literature on currency crises suggests these distributional effects are often the primary long-term impact, more significant than the aggregate economic effects. Wealth transfers from middle-class savers to hard asset holders and from creditors to debtors reshape economic inequality in ways that persist for decades after the initial currency event. Understanding portfolio economics in high-debt fiscal environments requires examining how rational actors might allocate assets when currency devaluation risks are elevated. Economic theory provides frameworks for thinking about diversification, hard assets, and international exposure in such contexts. Modern portfolio theory emphasizes diversification across asset classes to reduce risk. In standard environments, portfolios typically mix equities, bonds, and cash to balance growth potential against volatility. However, when government debt to GDP ratios exceed 100% and interest costs rise toward unsustainable levels, the risk profile changes fundamentally. Bonds and cash face currency devaluation risk, while hard assets potentially serve as stores of value. Economic research on high inflation environments shows that hard asset classes historically outperform financial assets during periods of currency instability. Real estate, commodities, precious metals, and recently digital assets like Bitcoin show lower correlation with currency devaluation than bonds or cash. This suggests increased allocation to hard assets makes economic sense when fiscal conditions create elevated devaluation risk. The economics of international diversification become particularly relevant. If currency devaluation is a country-specific phenomenon rather than a global coordinated policy, holding assets denominated in foreign currencies or located in foreign jurisdictions provides hedging benefits. Economic models of portfolio optimization under currency risk suggest allocating 30 to 50% of wealth to international assets when domestic currency devaluation probability exceeds 30 to 40%. Custodial considerations matter from an economic risk perspective. Assets held through intermediaries that face government jurisdiction create counterparty risk if policies mandate asset surrender or forced sales. Self-custody of hard assets reduces this intermediation risk, though it creates other costs related to security and liquidity. Economic analysis suggests the optimal custody decision depends on the probability and severity of government asset policies versus the costs and risks of private custody. The game theory of compliance with potential future mandates adds another economic dimension. If governments implement policies requiring asset surrender, individual holders face a choice between compliance and non-compliance. Economic models of enforcement suggest that actual enforcement rates are typically far lower than threatened penalties, creating a wedge between nominal legal risk and actual economic risk. Rational actors might calculate expected values, incorporating both penalty severity and enforcement probability when making compliance decisions. From a pure economics perspective, the optimal portfolio response to elevated fiscal devaluation risk involves increased hard asset allocation, international diversification, reduced intermediation through self-custody where feasible, and scenario planning for various policy outcomes. The specific allocations depend on individual risk tolerance, wealth levels, and ability to manage alternative custody arrangements. The economics of strategic Bitcoin reserves must be understood within the broader context of fiscal sustainability and historical patterns of government debt management. When governments face debt to GDP ratios above 100%, with annual interest costs approaching or exceeding 30 to 40% of revenue, economic history shows a limited set of available paths. The pattern of acquiring hard assets, revaluing them to improve government balance sheets, and accepting the currency devaluation that follows is not new. The 1933 gold revaluation represents the most direct parallel in United States history, but similar patterns appear across countries and centuries. The economic logic remains constant. Currency debasement through asset-backed revaluation provides a politically feasible mechanism for reducing real debt burdens without explicit default or painful fiscal consolidation. Whether Bitcoin serves this function depends on several economic factors: the scale of government accumulation, the credibility of official valuation methodologies, and the severity of the fiscal situation when policies are implemented. The framework established in early 2025 creates the infrastructure for such policies, though implementation remains uncertain. For those interested in these economic dynamics and how they might unfold over the coming years, make sure to subscribe to this channel. We'll continue tracking fiscal indicators, debt metrics, strategic reserve developments, and the economic signals that might indicate when theoretical frameworks translate into actual policy implementation. From an economic standpoint, the key insight is recognizing that fiscal mathematics often determine policy outcomes more than political rhetoric or intentions. When debt servicing costs become unsustainable and traditional solutions prove infeasible, governments turn to the tools that remain available. Strategic reserves and currency management represent such tools, used throughout economic history when fiscal conditions leave few alternatives. Understanding these economic mechanisms, historical patterns, and policy tools allows for better anticipation of potential outcomes and more informed asset allocation decisions. The economic analysis presented here is not prediction, but pattern recognition based on how governments have historically responded to similar fiscal conditions. Whether history repeats, rhymes, or diverges entirely remains to be seen, but understanding the economic playbook provides valuable context for navigating uncertain fiscal environments.